Chapter 19 is going to introduce plant assets and depreciation associated with them. We worked a little bit with it in the past, but now we're going to get back to doing more in-depth things with it. So Section 1 in specific is talking about buying the plant assets and paying property taxes. Your plant assets are usually the larger assets like cars or trucks or things you're going to use over a period of time. And so because you're using it over a period of time, you want to know what the return on your investment is, or the ROI. Your accountant is going to figure that up for you, and you want to make sure that you're using good information so that you can be sure to have, I'm going to shut my email up, guys. You want to make sure that you have a good prediction on what it's going to be so you know what assets that you need to buy. This will help your manager decide that. When you buy a plant asset, this is an example of what it will look like. When you purchase that plant asset, you're going to have a transaction that tells you the date, paid cash for what you bought, and how much. Now, it's not going to say if it's store equipment or if it's office equipment. You're going to need to determine that. So a shelving unit most likely is going to be store equipment. For instance, if you work in any type of merchandise store, you need shelves to put your merchandise on so your customers can see it. But as you're working through the problems, if you ever have a question, make sure you ask. Now notice you bought it on January 3rd of the first year. Remember when doing plant assets, they always have year 1, year 2, year 3. You bought it on January 3rd. So you get to use it for an entire year the very first year, which is a good thing. So when you record it, you're writing a check, you're going to credit cash, you're going to debit the plant asset account. In this case, it's store equipment. And these are pretty basic transactions when you buy a plant asset. Now, many times you buy groups of plant assets. You get a deal by buying multiple ones at the same time. So when you do this, there's a couple things that we need to step through to make sure that we're going to journalize it correctly. First of all, we calculate the estimated value of all the assets bought. This is what the value is. It does not mean that's necessarily what we paid for it, but that's what it's valued at. So we have two assets here. The first one is valued at $7,500. The second one is valued at $22,500 for a total of $30,000. That's their estimated value. But what we paid for them was not $30,000. We paid $27,000 for those two assets. So what we do to figure out how we're going to journalize it, the first asset was valued at $7,500. We're going to divide that by the total $30,000. If we go back to this slide, estimated value of the first asset, total estimated value. I'm going to take the value of the first divided by the total. I get 25%. Now I didn't pay $30,000, I paid $27,000. So I'm going to take $27,000 times 25%. That gives me $6,750. That's the cost that I'm going to assign to asset number 1. Even though it's valued at $7,500, my actual cost was only $6,750 because I didn't pay full price for it. I'll do the same thing with the second asset. It was valued at $22,500. I divide it by the total $30,000. I get an estimate value, 75%. So 75% of my purchase price, $27,000, is $20,250. This is the cost I'm going to assign to, and it should be asset number 2 here, not number 1, asset number 2. So even though the value is higher than what I paid for it, I want to make sure I'm journalizing what I paid for it based on the value. So then when I get to where I journalize it, and it isn't showing, the picture won't come up of the journal, but what I'm going to do is I'm going to put in here my office equipment was $6,750, my store equipment was $20,250, and my cash credit was $27,000 because that's what I actually paid for it.